Welcome to Dividend Talk, my friends. This is episode 147. An interview with Jeremy from Dividend Stockpile.
Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, buddy?
I almost feel like Pinky in the Brain, right? The answer from the cartoon, because it's a repetitive question. But I feel actually quite good. It's been a busy week again. It becomes like a broken record, right? This saying. But really busy. I don't know what it is this year, but April and now May again, it just continues to be stretching me everywhere. It feels like inflation is not only in money, but also in time. And, I guess it's also like tougher times in companies nowadays. A lot of restructurings everywhere, cost cutting, all of this stuff. And in the space where I work, this is no different. So it requires to step up a little bit here and there, and less time also for social media and such. So people have noticed I'm a bit more quiet, but the Friday evening is like sacred for me. So really happy to be here, and also really excited for our guest tonight. So it will be nice.
Yeah, we have a guest today, one of our members on Facebook actually, and Jeremy of dividendstockpile.com. Welcome to the show, Jeremy.
Thanks, appreciate it. I'm happy to be here.
Yeah, it's great to have you on. I follow your blog and some of your YouTube videos as well, so it's exciting to have you on here. But maybe just for some of our listeners, you might just give yourself a brief introduction of who you are.
Yeah, great. Well, my name is Jeremy. As you mentioned, I do run a blog. It's called dividendstockpile.com. It's motivation, inspiration, valuation, and just ways to grow your dividend stock account. I live in Florida in the United States. I family, 4 kids and the wife, and life is busy between my regular day job, the blog, family life, everything that goes with it.
Yeah, awesome. I think we can all definitely agree that life is quite busy. I know we were chatting off air about how busy it is running kids, a family, and then European DJI mentioned work at the moment. So it is tough to juggle all that. But we might ask some questions around that later, because I think it's a common problem. I think lots of people are working 9 to 5, are quite busy, and that's why I think dividend investing or dividend growth investing is the perfect strategy for guys like us. But before that, we might start with some news of the week. And this week there was some interesting news coming out of Philips. You would have heard us talk about Philips on this show before, particularly not all good. Mind you, they were the darling of the Dutch world a long time ago, but we know they had some issues with recalls of their respiratory devices. And now the shareholders are sending a message to the board members. European DJI, you'll probably know more about this. I think it's more of a Dutch rule, isn't it? This voting system they have to do.
So I honestly don't know if it's Dutch as such, but it's you need to approve the results of last year, and you need to kind of I don't know how to even technically say it, but like release the board of their duty for what they were obliged to do last year, so that they can continue with this year and everything. And there was kind of a, how do you call it, a proxy vote or something like that, where the shareholders effectively gave a strong signal that they don't really appreciate the performance of the board from last year. I believe at the top they were about valued of 50 billion as a company, now more around 14 billion as a company. It just shows like the misery that it went into. Also, this year, the dividends are more like a dividend out of the shareholders' pocket, because they can do a scrip dividend. I think it's called, like just shareholder dilution in the end. So, you can imagine that shareholders are totally not happy. I also read somewhere that some shareholders want to sue the board. Now, that I never really understand because they want to sue the board for a lower share price. But I never understand this really because that's the risk you have as an investor, right? Unless there's fraud, but then sue them for fraud. Don't sue them for a lower share price. But I'm not a professional investor, so I might just not understand this, but it's just me thinking logically. But it's really interesting to see like how this is developing there. The companies just really struggle. The golden boy that took over as a CEO, I don't know. I'm not really seeing anything of him yet either. And I'm just glad that I really quickly sold it because I got to learn over time that companies that are dealing with the American system, let's say court system, European companies, and the jury system is not something we're used to. Yeah, and I even sometimes feel that when you have a jury system, that science is not prevailing and these kinds of things, and it's really more about sentiment and emotion and how you influence a jury. And we are not used to this in Europe. So I think European companies just struggle to deal with that and how to get out of this litigation issues, probably almost often too trying to walk the honest path and not really thinking about just settling and see it as a price you pay to move forward again. And yeah, Philips is for me a textbook example of this. And also I saw again also in their in their earnings report that this apnea, how you say it, these respiratory issues, they just continue to knock on and put a struggle on the business.
Yeah, it is struggling, and I have to say this is a largely symbolic vote. It doesn't necessarily mean a whole lot. It does, in theory, open up, as you said, the board to litigation, and the ability there is they can sue them. It is there, but it's very, very, very unlikely to happen. As you say, you can't do it just for a drop in share price. You have to prove that the board is not acting in shareholders' best interests, which is quite difficult to do unless, as you said, there's fraud. But it was quite interesting. I know there was also a vote on the bonus of the CEO, which also did not go too favorably. But again, that does not mean they will not get this. They will not get the bonus. But it is, as you said, largely symbolic. But shareholders are starting to show, look, we're not happy with what's going on here. 76% voted against the proposal, so it's the vast majority are not happy. So I think we'll see big changes over the next 12 months with Philips.
Well, it's not their track record to make big changes, but I hope for the company as well. I'm just glad that I'm out. And talking of which, right, we also had a dividend cut, no dividend for Castellum, right? Castellum, 23 years of dividend growth, Swedish real estate company. And, there was some noise going on there with this Achelius investor stepping in, Rutger Arnold, the CEO, stepping out. And they now did a rights issue of, I believe, 10 billion, I guess, Swedish crowns. And also came as a surprise, stock down 15%. I mean, also Cibus that the other day, not too long ago, a share issue. So the Swedish real estate market is really let's say a hectic space at the moment because of the increasing interest rates. I've been also studying Cibus this week after the quarterly report. I really like their report. I think it's stable there. So I actually bought a few shares more. I asked for some advice on Facebook. There was nothing that changed really my mind. That was like a killer argument saying like, okay, I overlooked that. So I just nibbled in a little bit and averaged down. So it's not how you say it. But that's also the thing, right? It's easy to invest in calm waters, but usually the yields are lower, the investments are less attractive. And I'm wearing our sweater from the Dividend Talk web shop. You can't borrow conviction. I feel I have conviction in Cibus. I might go wrong. Hey, that's investing, but at least I can say I've done my homework, and I feel like this is a good moment to buy some more.
Yeah, nice. Cibus is not someone I currently hold. You're going for another high yielder there. You're starting to follow Ian Lopuk's advice with the high yielders, but it's interesting that you have so much conviction with them, considering they had a dividend cut and your experience with Castellum. So you have more conviction than I do in this type.
Well, so the dividend cut was like 9% or something like that, and I all understood it. And what is important to know, when I have a 10% yielder in my portfolio, like Omega Healthcare, I don't expect growth, and I even expect often some cuts. It's part of my understanding of the business. Yeah. But if I then look at Omega Healthcare investors over the last 5 years or something like that, I've been just on a yield on cost of 10%, just knocking in this money every time. So it's nice passive income. Yeah, and the same I have with BHP Billiton and Rio Tinto. So I've got 4 or 5 stocks like that, where I feel like if they cut the dividend in half, I'm still okay. Usually the thing that I don't like about it is the share price depreciation, let's say, at the same time. But I think with CBIS, it's pretty fair, and I don't see them cutting suddenly the dividend by 50% as such. So that's where my conviction is. And yeah, if they grow it even, then I'm just a happy investor.
Cool. And Jeremy, how about you? What's happening on your side of the world in the US? There's lots of noise coming out. There's loads of recession fears, inflation, debates about the debt ceiling. So what's going on over there?
Yeah, for sure. So just like in Europe, the inflation numbers has really been what's affecting everything, both from stocks to the economy to everyone's wallet, if you will. So that's definitely a big one. Hopefully, it sounds like it's starting to go down, maybe not as quickly as everyone was hoping for. I think the most recent number here for the U.S. Inflation rate was 4.9% year over year, and so it's higher than the government's target of 2% inflation. But it's definitely much better than it was last year when it was up in the 7, 8, and 9% range. So we're on the right track. We'll see if we can get it down even further. The biggest thing that's going on right now that's spooking a lot of people is the debt ceiling, as you had mentioned. So for those that might not be aware, the way our U.S. government is run is they have to get approval to borrow more debt on an ongoing basis. They have a debt limit, if you will. And so every few months or every few years, as we go further in debt, our Congress, which is obviously one of our branches of the government, has to go and basically approve the new spending limits. And over the last 50 years, they've raised it without issue like 72 or 73 different times. But for some reason, it seems to be getting the media's attention right now, where they're afraid that if they don't raise it, then the U.S. government's not going to be able to pay its debts. That means the U.S. will default on its obligations, which will, of course, affect our credit rating. And so if that really did happen, yes, there would be financial turmoil around the world, with the U.S. having such a big influence in the global economy. But the way I look at it is the politicians always do this. They always debate back and forth. They always say that we're not going to do it. We want this concession and that concession. But at the end of the day, even if it's a last minute vote, they usually do vote for it and raise the limit. That's one of their obligations as a form of government, is to pay the government's bills and allow it to happen. So the market's definitely reacting to it with the being afraid it might not be approved and we might go into default. But again, over the last 50 years, even the last 3 years, they've raised it multiple times. So at the end of the day, I think it's always going to be raised.
Yeah. When is that vote? When did they vote on that?
So they're currently under negotiations. So our President Biden has met with the senior leaders of each of the other parties in the government to try and work out a deal. Our Treasury has said that if it doesn't happen before, I think it's June, then there's a real possibility of it defaulting, not being able to pay our bills. But I think that's a little flexible. They can pull a couple levers and make it different. But it's definitely over the next couple months. So there's really 2 options. They can do a temporary measure where they'll raise the limit enough to get us through, say, the end of the year while they have a chance to negotiate, or they could just make a deal right now and it'd be over with.
Yeah.
How would America look like if the government just says, okay, for the next 5 years, we won't raise the ceiling and we have to deal, we just have to be within budget based on the income from our country?
That would be fantastic if they could actually do that and stay within our budget. I think the last time our budget was balanced was back in Bill Clinton era, 1992 range. So it's been quite a few years, if not decades, since we've had a balanced budget. But to be honest, if we did try to stay within our budget, our economy would tank, because the vast majority of our economy is based on debt. A lot of people would lose their job. All the government workers wouldn't get paid. There's quite a lot. A lot of our social services, we call it like Medicare and Social Security, like old age benefits and things like that. All that would be affected. It would be honestly an economic disaster if they did that. So what they really need to do is find out a way to cut budgets, maybe in the military or government payroll, something like that, to bring it back in line, so we don't have to keep raising the debt ceiling. But as long as people in the global economy are willing to buy U.S. Treasury bonds and U.S. Treasury bills, there's really no incentive for our government to make any changes, because it's always available money until it's not, and that's the issue. Is what happens if it's not.
Yeah. Well, Peter Schiff, I believe is his name. He had a long podcast about it this week on his YouTube channel. If you listen to him, then it's like America's doomed. But I think he's saying this already for 15 years, right?
Yes, he used to be called Dr. Doom, or something like that, because he's always saying that the global economy and the U.S. economy is going down the toilet, and to buy gold and stockpile all these hard assets. But he's made a living for himself being that person, and it's good to hear different opinions. I listen to his podcast as well, just to see different sides of things, but I don't agree with his philosophy that the world is coming to an end.
But to his defense, the best strategy that he's promoting at the moment is dividend growth investing. Because he says if for instance he's afraid that America gets hyperinflation, like what we're seeing in Turkey right now or in Argentina, he says the best is to buy dividend growth stocks with a healthy balance sheet. So that's very interesting, right? So it seems to that we have, because when you listen to him, like, oh my God, am I having the right strategy? So it was really funny that after 40 minutes he started discussing that the best is to have like blue chip dividend stocks with a healthy balance sheet. So I felt like, oof, I'm safe.
Exactly. Yeah, these companies that he's advocating for have been around a very long time. To your point, have good balance sheets. They have the ability to raise prices as needed, because a lot of them, especially something like a Procter and Gamble or a McDonald's, they can raise their prices to match the inflation, and most people will still use their products. So that's definitely good advice.
Right. So, well, speaking of dividend growth investing, we're here to talk about your journey as a dividend growth investor. So I think it's actually a good place to start with how you actually discovered dividend investing. When was that aha moment?
Yeah, for sure. Well, so some people on Facebook groups and Twitter ask me, how long I've been investing in stuff. So I've technically been investing since 1999, so 24 years or so. But really getting into dividend growth investing has been about 7 to 10 years ago. I started really focusing on individual companies and things like that about 10 years ago. And one of my very first ones was MetLife stock, ticker MET. The reason for this, my wife works there. And so we started investing in that individual stock. And, obviously every 3 months we started getting these dividends. We're like, oh, that's interesting. But we really didn't know what it was. And so for the first few times, I didn't reinvest it. Just sat there in cash because I didn't know any better. So I, dug into the dividend growth strategy. At the time, there wasn't a ton of YouTube and things like that. But over the years, continue to learn and grow. And one of your previous guests and one of, in my opinion, the best dividend investors, Ian Lopek, was instrumental when I first got started, because he was, talking about things like yield on cost and other things like that really sparked my interest. And then I just went down the dividend growth rabbit hole after that. In the past, I've done the growth investing. I've done the mutual funds. I've done the, capital appreciation is the only way, stack up as much money as you can and eventually sell it off when you get old and retire. But, living through the tech crash of 2001, living through the great financial crisis in 08 and 09, not COVID, there's so many opportunities for the stock prices to go down out of your control. And so if you're relying on the capital to live off of, that's going to be really hard. And that just reinforces my dividend growth mindset, that even if all those things happen, I'm not relying on the capital appreciation. I'd be happy if the stocks went nowhere for the next 10 years. I could accumulate more dividend growth stocks, but I plan on living off the dividends only. So I don't really care what the share price does. But with dividend growth investing, you really get a sense that you understand what your future income is going to look like. You don't have to rely on the larger stock market to really determine what the value of your portfolio is going to be. I know that a company like Johnson & Johnson or Kimberly-Clark or Procter & Gamble more than likely is always going to pay that dividend out. And so if I have a basket of dividend growth stocks, I can feel comfortable knowing what my income stream is going to look like later on in life.
Yeah, and I know you're quite transparent in posting your journey and including the numbers and figures, and we'll post your blog so people can go and check out your monthly updates. But how far off are you from living off your dividends?
Yeah, sure. I get that question a lot. So most people, when I post my numbers, are like, "Well, I could retire right now off of that." You know, that's how
That's what I was thinking.
you know, luckily and very thankfully, my wife and I both have really good incomes, and so with that, when we're trying to decide at what point can we retire based on our standard of living and the money that we have coming in right now. So while we do have a significant amount of dividend income coming in, it's not enough to replace our incomes. So we do end up saving about 40 to 45% of our combined income to invest with. And so I understand, like, obviously, if we're making, let's just say, $150,000 a year in salary, we certainly wouldn't need that much in dividend income. But we want a comfortable life. Some people call it fat fire, where you're retiring and you have excess money to go on the trips you want to do and provide for your children and things like that. So we have two goals. My first goal is to be at a point where my wife can retire from her day job in about 9 years. And so that's our first goal. So we have a certain dollar amount that we're trying to get to in dividend income by that point. And then my goal is to be done in the next 14 years. And then we'd hopefully be able to live just off dividends at that point.
Okay, so your wife is 9 years and you're 14 years, and you started this 10 years ago. So that journey would be 19 years at least to get to that level.
So obviously, some of the money that we have currently that we're using for dividend growth investments, we've been building up the whole time we've been investing so far. So even though I've only been focused on dividends for 7 to 10 years, we've been investing for 24 years. So all that money's been accumulating over the years, and so that's definitely helped us get there.
Yeah, and it's quite a long stretch. And you're already at 10 years, and you have a little bit to go. But how has your strategy evolved over the years? And I'm looking at your portfolio, which is quite interesting, and we might talk about the top 10 in a few minutes. But how have you changed as a dividend investor?
Yeah, absolutely. So I think most dividend investors go the whole swing from looking for just the super safe, very common names like your dividend kings and dividend aristocrats, because that's what's all over the internet. That's what if you type in anything, they're gonna say those are the best options. So I think people started there, and then they're like, oh, well, how about this 8% yielder or this 10% yielder? And so they go that route, and then they're like, oh, well, individual companies can be risky. Why don't I just do an ETF? So I think my path has followed that as well. I'm definitely getting to the point where I prefer to invest in ETFs and closed-end funds instead of individual companies. So that's definitely where I'm heading right now. For 2023, all my new money that's invested is only going into ETFs and closed-end funds. I'm not doing any individual companies this year. And the reason for that is just to build up my position in those ETFs to have them as a larger amount of my portfolio.
Yeah, but the good thing is you're in America, because this is really a pain point for us in Europe, because we need to have all those UCITS ETFs. I think they need to have a KIT and KID document. And with that, we then suddenly have an expense ratio of 0.3 or 0.4. Then the dividend yields, if you have like the Vanguard dividend growth fund or something like that, you have like a 1.7% yield, and then there's nothing attractive. And something like the Charles Schwab, we don't have here. We can't get it. There was some time that Interactive Brokers had a little bit of a brief flaw in their system that we could all buy it. But yeah, it's so hard for us. So what would you recommend to people in Europe that might struggle with that, with the selection of ETFs and such?
Yeah, that's definitely unfortunate that there's not that access, and we are very lucky in the United States to have a variety of options for us. Sometimes it's actually a detriment, though, because there's so many options, especially for a new investor. It's hard to understand what you need to invest in. So for those who can't do individual companies, ETFs, it really comes down to risk management and diversification. My personal criteria is no more than 5% of my portfolio in any one individual company, and no more than 15% in any sector of the economy. So only 15% in technology and healthcare and finance and things like that. That's going to help diversify. But you are going to have to do a lot more work if you're picking the individual companies. You have to be willing to stay on top of them and read the annual reports and understand the company a lot more than if you were to buy something like the S&P 500 index or something like Bob SCHD, because those ETFs are going to do the work for you, and they're going to filter out the companies that aren't doing so good. So you definitely have to put a lot more work as an individual investor.
Yeah. And then maybe when I hear talking also, right, I feel like it sounds so easy, dividend investing, right? You pick an ETF with a certain yield, you dollar cost average it. With many brokers, you can automate it. But for instance, I even feel that dividend growth investing is a very simple strategy compared to when I hear day traders or people that are trying to time the market, like sell low, or buy low, sell high. And then if I try to, in my environment, explain about dividend growth investing, people start already yawning. It's like boring, and why would you do that? And they continue thinking about crypto, all this stuff, or they say, put just all your money in your house. Why would you invest? It's not safe. And I'm wondering sometimes, like, am I now in this bubble that it just feels simple or what? But how is this for you? Are you able to inspire your environment around you with dividend growth investing, or are you also quickly hitting a barrier that most people are not even interested when you start opening your mouth about this topic? I'm just very curious if it's similar.
Yeah, it definitely is similar. So it's funny because when you're on a Facebook group or when you're interacting with Twitter, it feels like everyone knows about finance. Everyone knows about investing. Everyone has figured it out. But when you're in the real world and you're talking to your friends or your family, even in addition to dividend investing, just any kind of investing or any kind of financial related things, they just don't want to hear it. I think a lot of people just turn their head and say, I don't want to deal with it. I don't want to understand it. It's too complicated. So we definitely get that over here. So even talking to my family, my in-laws and relatives and things like that, I said, oh my goodness, you're 40, you need to start investing. They're like, I don't have enough money for that. So, why would I want to worry about what is going to happen in 20 years from now when I just have to pay the bills today? So we absolutely get that over here. So for me, it's really, when it comes to dividend investing, I really talk about the stability of the income that you can produce, and it gives you the flexibility and the options to do what you want later on. So if you can get to a point where you can get $1,000 a month or $2,000 a month in dividend income, look at the options that provides you. If one of your spouses wants to work part-time instead of having to work a full-time employment, if you want to relocate to another country with a lower cost of living, you can do that because you have this extra income coming in. If you're just investing for capital appreciation, you end up having to sell off your shares to live, and there's no certainty there. So I just talked to them about what the options it's given us, and gives us the option to let my wife retire early than what's typically considered retirement here in the United States. And we can use that if we want to. If not, it's going to continue to accumulate over time. But at least it gives us options and flexibility. I think that's the biggest thing about dividend investing.
Does your wife actively get involved in the investment decisions, or does she just let you to it?
Yeah, she really lets me to it. So she's 100% on board with a dividend growth strategy. We've talked through it. I've shown her like the projections on what it could look like. We talk about some of the investments that we've made, but the day-to-day, the details, she's not interested in. She trusts me to be doing it right. Obviously, she checks the balances. We talk about how much our dividend income is on an annual basis. So she's definitely aware, but I'm definitely the one that's digging into the details and making the decisions. Yeah. She tends to handle our day-to-day finances, like paying the bills and making sure the money is in the right place. But once she moves money from our checking account into our investment account, she leaves it up to me to make the choices.
Yeah, sounds like we have a similar story.
Okay, thanks.
I want to circle back to your portfolio, and I'm really curious about the closed-end funds. I know European EDGI said there's a struggle over in Europe in terms of ETFs, which there is, but we can invest in closed-end funds, not the US type, because they are still classified as funds. We can certainly in European types, but Why, what are you drawn to it with CFs? What do you look for? Or what is the difference between them and an ETF?
Sure. So actually, I did an article a few months back on my blog about an introduction to closed-end funds. So definitely take a look at that if anyone's interested. It gives you a brief overview of what they are, what their history is, and some of the big names here in the United States, at least. So you might want to look at. But a closed-end fund is actually older than an ETF. So closed-end funds have been around for over 100 years. And basically what it is an investment group decides to raise new capital for this new fund. They do a single money raise, so they might raise $100 million all at once. And once that money once they've hit their limit or their goal, they close off the fund, meaning no new money is able to go into the fund. That's why it's called closed-end fund. An ETF, as new money is poured in, those managers have to go out and invest that money. Like an ETF like SPY or VOO, the SP 500, as people put more money into with that asset manager, they have to go buy more shares of the stocks. But a closed-end fund is a capped limit. So once the IPO happens for the ETF, the only trading that happens is between investors. There's no fund that adds to it. One of the main benefits of a closed-end fund is because they tend to produce more income from the fund. It's very easy to get 6, 7, 10% on a closed-end fund, where a lot of the ETFs are more in the 2 to 5% range. So it's definitely a vehicle to use if you want the income. But when you look at a total capital, total valuation, some closed-end funds will compete with the market, and some are just there for the income. You won't get much capital appreciation only. But I like them because they produce a lot of income. They can invest in things that are not publicly traded. So if they want to invest in a private company or private debt or something like that, because it's a closed-end fund, they can pretty much do whatever their mandate lets them do. So it gives them a lot of flexibility.
Yeah, it's a shame because I was investing in some of the US ones, and I noticed your portfolio. You have BlackRock Science and Technology, which I believe is one of your favorites, and I had held them as well. I think they were an awesome closed-end fund, but that's no longer available to me. But it is, I think, a good option, particularly for people in Ireland and UK that want to invest in funds but can't invest in ETFs. We can invest in some UK CEFs, closed-end funds as well, which gives us the same benefits really as an ETF, and it's actually taxed a little bit better in Ireland than an ETF. But circling back to your portfolio, talk us through your top three. I think you have a mix. You have an ETF, you have a single company, and you have a closed-end fund. So you have a diverse range there.
Yeah, no, I do. And I go into the approach of I'd rather diversify my portfolio than having a concentrated portfolio. The common guidance is 20 to 25 stocks is enough to be well diversified, and that might work for a growth portfolio where you're looking for the highest capital appreciation you can get. So let's pick your winners and stick to those. But when you're an income investor, I like to spread out my income. So if I only held 20 stocks and one cuts their dividend, I'm out 5% of my income. But if I hold 50 stocks, and one cuts, I'm losing 2%. And so that allows me to make up the difference to my other companies a lot easier. I think I lost track, but I'm somewhere in the 55 to 57 total different investments in all of my accounts. So I'm very well diversified, but there is definitely a concentration on my top 5 or so. My number 1 position is the Schwab Dividend ETF, SCHD. I know that's the darling of the dividend investing community, especially here in the United States. That's about 10% of my entire portfolio. My goal is to get it closer to 25%. I'm really a big fan of that fund. So my next biggest position is ABV, ABBB. That's at about 3.5% of my portfolio. And then my is one of those closed-end funds we were just talking about. Is called UTG. It's a closed-end fund that invests in utilities. And so all the major United States utility companies are going to be in there. So things like NextEra Energy, Duke, Southern Company, all those the types of things they're going to invest in. The thing I like about UTG is it's actually on a total return basis beat the S&P 500 since inception. So it's been like a 14-year period where it's outperformed the S&P 500. So even though most of that return is coming from the distributions or the income, if you reinvest it, you'll still be beating the S&P 500. So historically, it's been a really good fund, and it has a lower risk profile because it's investing in stable companies like utilities.
Yeah.
My fourth and fifth, just quickly, is MetLife. MET is my fourth largest. And the main reason for that is my wife works there, so we've been investing in that company for a long time. And then my fifth largest is Pepsi, so PEP.
Yeah, it's a pretty nice portfolio. I do like the spread that you have. It's a mix of there's a couple of ETFs, there's a couple of closed-end funds, and then a couple of nice companies like PepsiCo there. But how long did it take you to decide on the makeup of that kind of portfolio?
Yeah, so I have criteria that I follow, like I had mentioned earlier, 5% in one company, 15% in any one sector, except for ETFs. If you have a broad ETF like SCHD or one of the S&P 500 funds, there's no limit to that because it's already diversified. So the way I really started off is I listed out all the different sectors of the investment community that I could potentially invest in. So your financials, your healthcare, your technology, your utilities. And I set a max of 15% on each one of those. And so once I got that number, I looked for what I felt were the best in each category. So AbbVie, Merck, Johnson & Johnson in healthcare. I picked Nexair Energy, Duke, Southern Company, things like that for utilities. And so I went through each of the categories and said, okay, these are the companies I really favor in that industry. These are the ones I'm going to dig into. And I'm going to set my allocations on each one of those depending on how I feel about that company. So one might be a 5% weighting, but the other one I'm not so sure about, so I'm going to do 3% weighting. And then the ones that I am interested in, but they're a little bit more risky, maybe it's only 1% allocation. So I built my portfolio around that. And anytime I make a new investment, I'm always looking to see how it fits into my allocation. Do I have enough available exposure in technology to add a new technology stock if I'm buying a new stock, or in healthcare? I'm always keeping myself within those limits when I go to invest in a new company. So when I first started off, I really just kind of picked the ones I felt were interesting and went ahead and bought those. So I got the diversification. But then as I've been building over time, I'll pick and choose depending on what sector is interesting, or if there's a new fund or something that comes out. One of my big favorites right now is a company called Brookfield Asset Management. It's a company, but the ticker is BAM here and BAMTO in Canada. But that one was recently spun off from their parent company. And so obviously I wouldn't have known about that years ago, but now that it's here, it's very appealing. So I went ahead and added that to my financials bucket. So that's how I kind of build out my portfolio over time. But as I had mentioned, I'm really focused more on the ETFs and closed-end funds now. So a lot of my new money is going there.
It's interesting how you look at diversification, because actually I use a pretty similar approach. I call that my 4-tier system. And it's indeed the top ones are really my anchor, anticipated. I'm not there yet, of course, because I'm in the accumulation phase, and I would love to own Nike, but Nike has just been not attractive here. But this, like to your point, like a top player, top-notch player in one of the sectors I would like to have Nike from, right? So are there companies also that you would love to own actually, and that you are targeting, but they're just never at an attractive price that you have yet to be able to initiate a position in?
I try to stay within the companies I already have. I don't like adding a lot more because I already do have so many. But I posted about this the other day on Twitter. Apple has always been very appealing, but I cannot justify the valuation right now. It's just way too expensive. But obviously, it's a top quality company. It's a leader in their space. I have probably 8 or 9 different Apple products at my house. So like, it's definitely a company I want to own. But with a 0.5% yield growing at 8 to 10% a year, it's not that appealing to me. But if the valuation went back down to something more reasonable, maybe a 20 PE or something like that, it'd be something that I'd be interested in, but not at the current 26 or 28%, 28 PE that it is right now. There's just not an appeal to me as a dividend investor.
Yeah,
so that's definitely one.
Good. Yeah, I had the luck to be able to buy Apple at the 13 PE several years ago, just before Buffett entered, and then we never saw it back anymore there.
Yeah, I invested in them back, I think it was 7 or 8 years ago. So probably similar time. And that money was a great yield on cost. That was somewhere in the 3% range. But
Yeah.
you know, any new money now, it's just not worth it.
Yeah, true. True.
So you're investing quite a long time now, nearly 10 years. You've must have picked up, must have made some mistakes along the way. What's the biggest lesson, or what lessons have you learned over that time span?
Yeah, for sure. So it's going to sound a little cliche and probably heard it before is don't chase yield. That's definitely the first one. One of my biggest regrets, well, not my biggest regret, but my biggest loss right now is a company out of Canada. It's called Algonquin Power. It's a ticker AQN. They had a 40% dividend cut, and the stock price has gone in half since I bought it. So that's definitely a tough one. And the reason why they're having such a hard time is because of all the debt that they had. So I'd say the second realization is really understand the balance sheet and how a company operates. This particular company, AQN, has a lot of variable debt. So now that the interest rates have been going up, their debt service level has gone up too, and they weren't able to afford the debt that they took on. So for a long time, they were growing really quickly, but then with the interest rates going up, they had to cut back on everything. They had to cancel some expansion deals that they had, and they're having a hard time covering the interest expense. So, you know, understand the balance sheet would be the next one. The last one, and this goes to your t-shirt there, EDGI, is you can't borrow conviction. There's been so many times where I've listened to someone on YouTube or on Twitter or whatever pushing a particular stock, and I end up either buying in at the wrong time, buying in during the hype, or just not having the conviction to hold on to it long enough. And so I've taken some losses, or you know, just never been comfortable with that particular holding. And so that would be my last recommendation, is make sure you know what you're buying and why you're buying it, so that when things do go south, you understand what you have and you're willing to stick with it.
And do you have an example of a stock where you stepped into that kind of trap where you gained that learning?
Yeah, for sure. So a more recent one is the ticker's IIPR, Innovative Industrial Properties. It's
This is
a
the marijuana. I guess they have greenhouses or whatever it is.
so yeah, so they're a real estate investment company, a REIT, that invests in the greenhouses that grow the medical marijuana here in the United States. And I'm not a proponent. I'm not against marijuana. I don't really care. But you know, over the last few years, it was definitely a hyped industry. And so I thought, oh, as a dividend growth investor, this is a good way to play that particular market, because they don't sell the marijuana, but they grow it and they get the rent from it, you know. But if you look at the chart, I think I'm down 55% on it. And a lot of people are talking about dividend cuts. So that's one that I got caught up in the hype and, you know, not really doing full due diligence on. Luckily, it's a relatively small position, and I am still getting paid dividends for it. But more than likely, the principal, or you know, the stock price is probably never going to be back to where it was when I bought it. So that's definitely one of them. I didn't really do my full research. I just kind of hopped on that.
I guess there are also stocks where you jumped in and maybe without doing the full research, and it just like doubled or something like that, right? It's not always like that from my experience. Because I sometimes even get inspired by others. I do my homework, but I can even imagine about IIPR that the risk with such hypes is that in the moment you're extrapolating the growth into the future, into infinity, right? And not even might spot that it's in a hype while the industry is still too young. Yeah, so usually I can make easier such mistakes that I'm not able to zoom out, because the balance sheet might look nice, the last 5 years growth numbers might look nice, there's a catalyst in the form of better legislation and everything, right? And an open policy to this. So it's really hard in the end still, right? Because it could have still just doubled.
Absolutely. Yep. It's tough to be early. It's tough to stick with a company for the long term. But if the temporary growth isn't there, or you know, the stock price goes down, it goes back to the conviction thing. You really need to know why you have it.
Awesome. We might move on to some listeners' questions then, unless you have any more questions, European DJ.
No, I think it's. I mean, we could probably still speak for an hour. It's really interesting, but let's show some respect and honor to the listeners.
Cool. Phil has asked his standard question to all our guests at this stage, and it is: how would you rank the following by importance? Revenue, earnings, cash flow, and dividends.
For sure. So it would have to be cash flow first, because that's what pays the dividend. If you don't have extra cash coming in, you're not going to be able to pay it. You might be able to pay it through debt or something like that in the short term, but at the end of the day, it really comes to cash flow. So it'd be cash flow, dividends, revenue, and then earnings for me is how I would rank them.
Yeah, pretty much similar to what we said before. And the second part of Phil's question is: how would you approach if you had to cut the number of positions in your current portfolio by 2?
So like in half?
Yep.
Okay. Wow. So at my part in my investing journey, as I said before, I'm 9 to 14 years out from when I plan on using the money. So if I had to cut anything, I would cut the lower dividend payers yield wise, because I don't have a lot of time for the dividend growth to take effect. So if there's a stock that's, let's just say Apple or Costco that is paying 0.5%, if I had those in my portfolio, I would have to cut those first and focus on the mid or higher yielding stocks, just because my portfolio is at a point where I need the income sooner than later. So that's the first thing I would do. I'd go through my list, filter by dividend yield and dividend growth, and whichever ones are the lowest, I'd cut there right now.
Do you have a minimum yield when you're selecting a stock in the first place? Do you, for example, is it 2.7 or is there a minimum?
Yeah, there definitely is. 3% is my minimum, and I follow the Chowder rule, where the current yield plus the 5-year dividend growth is at a 12. That's my goal. So if the current yield is 3, I want to have a dividend growth average of 9 to equal 12. And so that's the first criteria. Obviously, I'll make exceptions to that, but that's really what I'm looking for. 10 would be the absolute minimum. So if you're getting 3% today, I want to see at least a 7% growth rate.
Okay, makes sense. Gordon has asked, do you think it's possible to run a dividend portfolio that's low maintenance style by just looking at the annual reports and skipping quarterly earnings?
Yeah, I definitely think so. I think especially if you do your research up front and you really have picked good quality names, there really shouldn't be a lot of changes on a quarter-to-quarter basis. You really should see the trends over a year time frame. So for instance, if you're investing in something like McDonald's, you can get a pretty good sense on an annual basis if they're continuing to sell hamburgers, if people are continuing to go there to get their coffee in the morning. It really shouldn't be something you need to look at every single quarter. Now, if you're looking at more speculative names or smaller companies, I would definitely think that doing a quarterly review, or at least a quick check-in, would be appropriate. But if you're really looking at those blue chip, long-term dividend companies, or you're investing in ETFs, you really don't have to check on a quarter-to-quarter basis. I personally do, because I'm interested in this investing, and I like to be involved and understand what's going on. But with my 50+ companies, I don't have a ton of time to look at every single one. So I'll do things like follow on Seeking Alpha and Yahoo Finance and things like that, just to get a sense on what the numbers look like for the quarter and if there's any major news. But I don't really dig in much more than that on most of my companies, because I've done the research ahead of time. I understand what Kimberly-Clark's going to do. I understand what NextEra Energy, the utility, is going to do. I don't need to know, was profit up 2% this quarter, or it's not really important in the long term.
Yeah, I tend to agree. For most investors, for most people, you probably don't need to be reading quarterly reports. Just filter out the noise. You'll make less rash decisions, unless, as you said, you're expecting some bad news or you're keeping but.
Yeah, and if you're looking to invest in a new company, I would absolutely look at your quarterly return review. I would listen to the conference calls. I look at investor presentations. Absolutely get as much information as you can as you're researching a company. But once you made a determination that it fits your risk profile and something you want to do, then I think yearly definitely is more than appropriate.
Cool.
Yeah, I would only look at sometimes when there's a large price fluctuation. Yeah, that's because it's true for me. Earnings reports is just passion, and also in dividend talk. And also, what I really love is like you remember Kimberly Clark, Derek? We started talking about inflation. When was it? Start of 2022,
Yes.
2021, something like that. Because Kimberly Clark started to mention it, and it took half a year, and then it really had everywhere an impact, right? And did we do something with that information? Probably not, because we dollar cost average. But however, it did make me, how is it, more aware of where to look for, what companies to maybe check a little bit more on the balance sheet, right, before buying. And I think I benefit from that now 1.5 year later down the road. Yeah, so for that point of view, it helps. But to your point, Jeremy, you don't need to, after a while, read all the quarterly reports after you have your conviction, let's say. But for me, what I do look at this, it's like, I check the prices like once a week. I know kind of what they trade at on average. So if I suddenly see somewhere price -10, and, being on social media, it helps with following, because they will tell me it's -10%. That's usually a good trigger, because normally prices don't move this much without news, right? And usually there's something fundamental or potentially fundamental at play.
Alexandros has asked us, any good advice for incorporating Chat GPT and similar tools into your research process?
Yeah, so I've played around with it a little bit personally. I haven't used it to make a decision, but if you go on there and you type in provide a financial report on whatever company you're looking at, it's going to spit out all the key financial ratios. It's going to tell you how their earnings are, what their debt level is. It's going to give you all the information, but it's really all the same information you can find online yourself. So what ChatGPT and those type do is, as of right now, they just pull from what's out there on the internet. So what other people have written, so the quarterly report. So it's going to pull all that information. One thing I have found is that it's not always up to date. So you're not always going to get the current information. But yeah, you can definitely get payout ratios and debt levels and things like that by using ChatGPT. I just haven't found it better than doing my own research.
Yeah, I just don't see how I could use that over using something like, as you said, the annual reports, or even something as simple as Kyphin that I use, or Seeking Alpha. I have all the information right there. I don't need a robot to spit back the same numbers to me, and I'll probably end up double checking it anyway, because I won't trust everything it's saying, because I know it's not 100% accurate or up to date. So it's probably going to waste more of my time than actually helping me. But I don't know. That's just me.
I think also you get more conviction looking at it yourself. If you're doing the research and spending the time and you get a full understanding, you feel more involved in it than if you just ask a computer program to tell you what the numbers look like. So I think in a few years it might be more useful, but as of right now, I just don't see it.
I'm actually still curious about it, so I want to test a bit. For instance, I spend a lot of time on creating charts sometimes, right? But filtering out all the dividend numbers and such. I'm just wondering, can't I just, give it a web page with the dividend history and say, create a chart for me? I really wonder, because there are some, they have some really good trending functionalities and such. So at least I want to play a little bit in that, because to automate a little bit more. But that's about it. And ChatGPT, I believe, is an old data. I think Bart, the ugly sister from Google, is more using real life search data. So I think we'll get there, that it also will have like real-time data based on the web. But I enjoyed actually quite a lot. But to your point, how you said, nothing beats reading a book or doing your own homework.
Yeah. The fear is you just type into Bard or ChatGPT, should I invest in XYX, and it'll say yes, and then you go and make your whole investment decision based on a robot, essentially.
If you type in there, what are the best dividend stocks to buy, it's going to spit out the most common ones. It's going to give you the McDonald's, the Procter & Gamble. But does that really mean it's truly the best for you? It's just spitting out information at this point. So it's hard to take that as conviction and invest based on that.
Nice. Marek has asked us a question. Actually, this is the third time he's asked, and apologies every time you have asked. we had already started the show and had not had these questions in the show notes, but we are definitely going to get to it tonight. And he's asking us, how do you estimate cash flow growth when it's negative?
Yeah, I think it's important what he also mentions here. He gives us an example, Nationale Nederlanden Group, the insurance company. And honestly, I don't use a discounted cash flow model for insurance company because they have usually so many transactions going on, and also on the balance sheet, they have a lot of assets in the books, which are effectively bond portfolios and everything. So the cash flow statement is just not reliable, in my opinion, to analyze an insurance company. So I always look at EPS, and EPS is for me the number that I count on. The same as that with a real estate investment trust, you look at FFOs, funds from operations. So it is some sectors, they have some specifics. Also, if you go to pharma stocks, all pharma stocks report basic EPS and core EPS. And core EPS is where they take the amortization out and everything. Because they invest a lot in R&D, they need to put the value on the books, but half of the R&D never sees daylight, so they need to depreciate it. That's why they take it out of earnings again. So it is important to understand a little bit the industry you're investing in and what the metrics are, what to look like. So with an insurance company, I look at EPS and I look at solvency ratios. In Europe, it's a bit easier to find the solvency ratios because of the European Union really enforcing those companies to report on this. And the solvency reports ratios effectively tell you, like, can they fulfill their obligations, from a debt point of view. And that's what you want to look at. I prefer it like at least 2 times 200%. And then the EPS, well, that's then the number that I look at.
Good. Well, I hope that was worth the wait, Marek. Actually, I was quite curious about the ChatGPT question, and when you said the top 10 dividend stocks. So I just went ahead, signed up, and asked it for the top 3 dividend growth stocks. Can you guess what the top 3 are?
Johnson & Johnson, Procter & Gamble, and McDonald's would be my guess.
European DJI?
Johnson & Johnson, Microsoft, PepsiCo. No, Coca-Cola.
You both have 2 correct each. Johnson & Johnson number 1, Procter & Gamble number 2, Microsoft number 3. And what I was impressed with, it does actually tell me, it told me that its cutoff date of knowledge is September 2021, and also told me I should do my own research as well. So I'm quite impressed with that.
Nice.
Simon has asked us, on last week's show we mentioned our watch lists, and it got him wondering about our preferred tools of the trade. What do you guys use for alerts, watch lists? They can be both paid and free.
Go ahead, Jeremy.
Okay. So I use a few. The main ones I would use would be Yahoo Finance. I create a watch list on there, and it's going to send me alerts to my phone if there's anything major going on with the company. They also have news articles attached to those companies. Another one I really like a lot, and it's mentioned a lot, is Seeking Alpha. So obviously, they have the financials there, but they also have individual authors, posting articles about their opinions and their information about the different stocks or others. So those are good ones. You can add a watch list there. And if anyone writes an article about your company or there's news about your company, you'll get an alert for that. I used to write for them back in the day, so but that's been a while. And then the other one that I like a lot is FinViz. Is a popular one for their financials, and so they do financials, charting, things like that. So I use that one a lot too.
What about you, European DJI?
Yes, so there are two parts here that I want to answer. First of all, screening, how to get things on your watch list. And after a while, I just know so many stocks from from research. So I've got kind of my own database in G Sheet with everything that I track. But typically, it will be for American stocks going to the Dividend Aristocrats file from Dividend Radar. and that's where you can screen for stocks. And then when there are some interesting, I put them on my watch list, and I use the CNBC app because I like CNBC a lot. It's really easy to see my watch list. And also the news is always under the watch list of what's happening to the companies. And when I click it, I also see like some basic data, which is more than enough for me. So for me, it's actually CNBC app. In the past, I used Seeking Alpha, but I kind of somehow naturally moved away from Seeking Alpha, and because I used it a lot for the transcripts, but I moved to Quarter for the Quarter app. So I'm not anymore on Seeking Alpha after they made it a paid subscription. It's not of value for me anymore and don't want to pay the money for it.
That makes sense. Yeah, the Quarter app is an excellent resource because they do the conference calls, they do all the investor presentations, plus the data you had mentioned. So there's a lot of great information on that one.
Yeah.
Nice, good picks. Okay, that's all the questions we have. Thanks to everyone in the community for asking questions. We might finish up, Jeremy, with a stock pick of the week, if that's okay.
Okay. Yeah, so if anyone follows me on Twitter or the Facebook groups, you'll probably know my answer here, but it's a company called Next Era Energy Partners. The stock symbol is NEP. So you probably have heard of Next Era Energy, the utility, which is one of the largest utilities in the United States. They have traditional utilities like your gas and your coal-fired utilities, but they also are the largest producer of renewable energy here in the United States. So they do like wind and solar and battery storage. Well, a subsidiary of that company, this NEP that I'm mentioning, is the 100% renewable only division of Next Era Energy. So when Next Era Energy builds a new wind plant or solar plant, they sell those assets to their subsidiary, NEP, and NEP then contracts with your local cities and governments to provide long-term power agreements with those cities. So the cities can say they get all their power from renewable energies. And so I really like NEP for that because they're focused 100% on sustainable energy, and that's one of my big passions personally is the green energy, if you will. The nice thing from a dividend investor is they have a really good dividend policy. So they're paying north of 5% yield right now, and management every single quarter when they have their earnings announcements, they reiterate their dividend policy. So their expectations from now to 2026, at least, their expectation is to be able to raise the dividend another 12 to 15% each year through that date, and potentially further. So going back to the chowder rule, we talked about having a total of 12. This is more like a 20. So you get a 5% current yield and up to 15% growth. And the reason why they can provide that growth is because they do have these long-term contracts with these municipalities. They sign 20-year agreements to provide power. So they know what their revenue is going to look like, their cash flow is going to look like, and they know how many new projects they're bringing on board. So they know that they can forecast what their world is looking like. The next cool thing about it, and that's why I want to mention this week, is they just announced that they're going to be selling off all their natural gas parts of their business and only focusing on solar, wind, and battery storage going forward. So they're billing themselves as America's only and largest renewable only utility. So that's obviously that's a big focus of mine. I think that's where the world is going, to renewable energy. And here in the United States, renewable energy has a long way to go. So I think there's a lot of tailwinds for the company. They've raised their dividend every quarter for the last, I think it's 9-10 years. So they raise it a little bit each quarter, and it comes out to that 12 to 15% a year. So I have a large position. It's actually one of my larger ones. I have somewhere in the range of like 500 shares of them. So it's definitely a big conviction of mine.
And maybe out of curiosity, how do you look at the potential in cash flows coming from renewable energies? Because, for instance, I'm a big fan of natural gas in Shell because it's a transition energy as I look at it. And I see that it's really hard to get the same kind of called margins, let's say, on renewable energy when we look at electricity and such, and because also those companies really start to become a utility in that case. And I have a fear always that it's a way more low margin business than gas and such, because that's where you have governments at play and kind of a cartel. So I'm just wondering how you look at that, at the cash flows out of that.
Yeah. So here in the United States, it's there's a lot of subsidies for green energy, especially 2 years ago. They passed one of the biggest renewable energy bills they've had in a while. It's called the IRA. And so there's a lot of incentives for companies to build out renewable energy. And a lot of the cities and companies around the country want to say that they're using renewable energy. So I think there's a lot of demand. And what sets NextEra Energy apart is their scale. You know, they are the largest utility in the states. So they have the buying power and the ability to find the contracts that make sense, that do have the good cash flows, that do make sense on a long-term basis. So that's what keeps me interested in them.
Yeah, nice pick. Something I feel like I at least need to spend 10-15 minutes on reading last quarterly report to see if it impresses me.
So I put a poll out on Twitter the other day saying, you know, which company people want me to do a deep dive on, and NextEra Energy is the one that won. So I am working on a long deep dive for NextEra Energy on my blog. So look for that in the next couple of weeks.
And then you will put a link on Facebook, right?
Yes.
Super. Great.
Awesome. Well, a 5% starting yield and a 15% dividend growth rate over the next 3 years. I mean, you're going to hit 8% yield on cost there. Probably in that time, if that doesn't impress you, European DJI, I don't know what does.
No, it does. It does. It's just more like, can I have place for another energy company? Because Jeremy mentioned also 15% allocation to a sector, and I think I'm a bit above that with my ExxonMobil and my Shell and some of the others.
Yeah, we'll make up a new sector for you called renewable energy. It's different to oil and gas. It'll give you some wiggle room. But no, it's an interesting pick, and actually I will wait. I will not look at the company until you release your article. I will make that my first part of my research, but I'm definitely putting them on my watch list. It seems quite interesting.
Sounds great.
So thanks a million for that stock pick, and also thank you so much for coming onto the show. An hour and a bit has flown by. I don't know where the time has gone, but it's been really interesting to chat to you. We could have asked you a lot more questions. I had a lot of questions about America's debt ceiling, and then even when we're going through it could have been so much more. But thank you for taking an hour or so out of your day to spend with us here on Dividend Talk.
Absolutely. Really appreciate you guys inviting me, and it was a great discussion. Happy to come back anytime if it makes sense. I really appreciate it.
And to all our listeners, thanks again, and thank you for all your questions, and we'll see you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.